How long do you need to keep your records? Everyone says 7 years. That's the rule of thumb you'll hear from pretty much everyone. But if you just take that at face value, you can get yourself in trouble. Here's the actual rule and what you need to know about keeping records for your professional corporation. Under the Income Tax Act, records must be kept for 6 years from the end of the last taxation year they relate to. Let's just pause on that. 6 years from the end of the tax year, not from the date on the receipt. So if your corporation has a December 31st year end and you have a receipt from January 2024, the clock doesn't start in January. It starts on December 31st, 2024. 6 years from there gets you to the end of 2030. That's where the 7 year rule comes from. It's a rough approximation, works most of the time, and it's aligned with CRA guidance. But there are certain situations and certain types of records where the rule doesn't apply cleanly or even at all. First, late filings. If a return is filed late, the clock changes. So you're now keeping records for 6 years from the date the return is actually filed. Second, disputes and objections, CRA, whenever you're in tax court. You would need to keep those records until that process is fully resolved. Third, if CRA formally requires you to retain certain records longer, then you have to comply with that. The bottom line really is if a year is still in play, then don't destroy anything related to it. And there are also some categories of records where the 6 year rule doesn't really apply in a practical sense. I like to group things into three main buckets for easier understanding. First, the easiest bucket is your typical receipts, invoices, transaction info. Those relate to a specific tax year, and the rule applies pretty cleanly to most of these. Keep for 6 years after the end of the tax year. Second is capital property and investment records. These are the records that affect cost base and any gains or losses upon disposition. In practice, you keep them as long as you own the asset, plus 6 years after it's disposed of. So if you bought some capital assets or property years ago and still own it, you're still keeping that documentation. Third, permanent corporate records. Things like your minute book, articles, and share registers. These should be kept for the life of the corporation and typically beyond if the corporation is wound down. Fourth, this is a bonus bucket and not one of the main three, but if you're running a medical PC, there's a good chance you have some patient records. This is a completely separate track. In Alberta, CPSA generally requires records to be retained for at least 10 years from the last entry and longer for minors. That's medical legal, not tax. And I'm going to stay in my lane here. For detailed requirements, please refer to CPSA guidance. Now, you might be thinking, why don't I just keep it all? Because I've had many of these conversations. That can work, but there's a flip side to keeping more records than you have to. Once you're past the required retention period, keeping everything forever can actually work against you. The more records you retain, the more information CRA could potentially review if you're audited, and the more positions you may need to support or explain. Just to clarify, that doesn't change CRA's powers of reassessment or audit, but it does change your practical exposure by having more surface area available to potentially defend. So let's walk through a real example, which I think is pretty close to what most physicians do. So we have a physician about 20 years into practice. They've got banker's boxes stacked in their garage, labeled with the years they relate to. They even nicely separated out the personal tax records by year as well from the corporation stuff. Yes, it sounds organized since it's grouped by year, but everything within those years is mixed together. Expense receipts, capital purchases, investment records, share subscription documents going back 20 years. And you can imagine 20 years into practice, there are significant retained earnings in the PC and quite a few investments. Some simple publicly traded stocks, but a lot that are not. So real estate and private shares. Now, whenever any investment inside the corporation gets sold, probably something long-term and illiquid. We need to substantiate the original cost base from 10, 15, or 20 years ago. Sorted year by year boxes doesn't really help. We need the exact supporting documents. And if you can't substantiate the cost base, CRA has the discretion to treat it as zero or whatever it deems is reasonable. On a $50,000 private share investment that's doubled in 10 years, that could be the difference between paying tax on a gain of $50,000 or the full $100,000 proceeds if you can't substantiate the cost base. So the lesson isn't keep everything, it's keep the right things and know which ones actually matter long term. And what I tend to see is that most physicians either keep everything until they run out of space, their accountant tells them otherwise, or they wind down the corporation. And this part matters. Having a written records retention policy is the gold standard for a well-managed professional corporation. I'll be creating a separate video on the key policies your PC should have, and this is certainly one of them. And also a few quick compliance notes. CRA is very clear the legal responsibility for record retention is on the taxpayer, not on your accountant. So hoping that your accountant has kept a copy of supporting documentation is not a foolproof strategy. Your accountant has their own records retention policies regarding client working papers. So don't assume that just because you emailed your accountant at some point that they have kept a copy in the permanent file. Also, electronic records must remain readable for the entire retention period. And also, you generally can't destroy records early without CRA permission. And if the corporation is wound down, some records still need to be kept a little after dissolution. To recap, think in 3 buckets, each with its own rule. You have tax records, kind of your typical tax record, 6 years from the end of the year with extensions for late filings or open disputes. Capital property and long-term investments, keep those records as long as you own them, plus 6 years after disposition. And you have your permanent corporate records. Keep them for the life of the corporation and a little beyond if needed. I hope this was helpful. If you have any questions, please let me know in the comments. All the best, and I'll see you in the next one.